who have just about knowledge about the stock markets and whatever we've learned in the last few months. So the strategy that I'll be covering is self-explanatory in most of the places, and I would like to give any kind of amplification notes or anything if should anybody have any doubts at the end of my presentation. The lure of big money has always thrown investors into the lap of stock markets. Making money in equities is not easy. It requires patience, discipline, also a great deal of research and a sound understanding of the market. Although no sure shot formula has yet been discovered for success in stock markets, what I'm going to present to you are certain ground golden rules, which if followed prudently, may increase your chances of getting a good return. These key words, that is patience, discipline, research, you'll keep hearing quite often during the course of my presentation. Let's straight away dig deep into our strategies. The first, I think the fundamental thing which everybody needs to identify is whether one is joining the stock markets for the purpose of doing trading or carrying out investment. So you have to identify whether you're a trader or an investor. The essential difference between a trader and investor is trader is somebody who buys stocks and might sell the same within minutes or hours of the day, whereas investor is somebody who does it for long-term purposes. Either he holds on to certain stocks for few weeks, months, or sometimes even many years. You would have heard of your elders or somebody in your family who's holding on to a share of Reliance or Infosys for last 15 years, 20 years. It's been done for the purpose of education of your children or marriages of kids. So that is the difference between a trader and investor. So you should clearly identify the difference as to that what does the two mean. And because why do we say so is because the trading strategies are totally at variance with the strategies which an investor adopts. So right at the beginning, one has to adopt so that the foundation of your stock market journey is quite sure and firm footing. Second is one has to understand the basics of stock market. Now, right at the beginning, the way we have been taught right at the beginning as part of our journey during this elective, one has to clearly understand the basic definitions of what is a stock market, what is the BSE, what is the NSE, what is Sensex, Nifty, what are the timings of the stock market, who is a stockbroker, how does the market generally move up and down, how does the price of a certain share goes up or down. So these are the quite basic fundamentals that everybody has to acquaint himself with. One should not neglect these basic fundamentals, and one should go step by step, and only to build your trading or investment strategies in the later time frame. Spend at least a few days mastering the basics so that you actually know what to do once you get yourself a trading account. I'll come to it subsequently as to how do you do that and what is your trading account mean. I'm sure in the previous presentations, people have already covered what is a demat account and how does one actually carry out the process of start trading or investment. So that would have already been understood by everybody. Now, next is selecting a stockbroker. Now, who's a stockbroker? What we generally see in the layman's term, when we want to carry out investment in stock markets, one needs to apply for a demat account, and one needs to link up this demat account with your savings bank account so that you carry out your trading or investment. And the popular software brokers or stock brokers are the Zero Aadha, Pro Stocks, Upstocks, or even ICSA.com. They give special attention to the brokerage. You need to, while identifying which stockbroker to adopt for, one needs to pay attention to the brokerage which the stockbroker is going to charge us. It might not be so much of a value for somebody who's into a long-term investment, but for somebody who's doing trading on a regular basis, because for every trade that you pick up, he's going to charge you for a certain percentage. It could be a flat percentage, or sometimes depending on the percentage of your value of the transaction that you carry out. So it is very, very essential to identify the right kind of stock broker. The most popular ones are, as I said, Zero Ada, ProStocks, Upstocks, or ICSA.com. The next step is this is the basic fundamental mistake which majority of them make, is to get into a herd mentality. Typical buyer's decision is usually heavily influenced by the action of his either acquaintances or neighbors or relatives. One generally tries to invest in a particular stock and gets into a tendency uh, for potential investors to do the same. Um, this particular tendency, that is following and blindly aping somebody, is bound to backfire. You might get lucky a couple of times, and that is what the initial loopholes are, lacunas are, because generally when somebody gets lucky by investing based on somebody else's stock tip, you try to get lucky a couple of times, and third and fourth time, without doing a proper research, you follow the herd mentality, you are bound to make mistakes and bound to falter. This is where the famous saying by Warren Buffett comes to play, is be fearful when others are greedy and be greedy when others are fearful. So this particular one aspect one will learn in his journey in the stock markets, and not carry out with the herd mentality. Next is, you have to take an informed decision. As I was mentioning in the earlier slides also, a proper research is essential to carry out before doing any kind of investment. Investors generally go by the name of a company name which is very fanciful, might sound good, but merely by the name of the company one should not invest, but by carrying out a thorough research, and always carry out investment in a business which you understand. For example, what of late what generally people are seeing is cryptocurrency and bitcoins and such like investments. If you don't have any knowledge about it, one should not invest in such businesses and such stocks. So do a thorough research, and only when you understand the business model of a particular business, only then one should invest in a company. Don't try to time the market. This is a common phrase that one keeps encountering. It is never easy to identify the top of a certain share or a bottom of a certain share. So, especially in the initial stages when you're starting your investment journey, one should be very wary about such thing. You price levels are something one should not try and time it. There is never an easy time to invest. So majority of the investors, however, do just the opposite, and thus lose their hard-earned money. You try to think that this is the most cheapest rate at which a stock is available, and then you buy it, and then without doing any research, then suddenly you'll see that another 5 to 10% the share price has dropped. Similarly, you want to sell at a time when you think that stock price has reached at a certain peak, and you prematurely sell it, and then later on you identify that probably that is the breakout price of a certain share, and you see that the share has jumped 10, 15, 20% more. So the stock would have been idle for a very, very long time period, probably for 2, 3, 4 years also, and suddenly when it gives you 5% jump, then you, in a hurried manner, you sell it, and you realize it later that the actual price has broken out now, and it has started on a long bull journey later on. So catching the tops and bottoms is a myth. In doing so, more people have lost far more money than people who have made money. Then the consequent point to this is, how does one do it? So the only and simple foolproof method is to carry out a disciplined investment approach. Historically, even great bull runs have shown bouts of panic moments, like what we have been observing the last week or so. The stock prices, Nifty has dropped from the highs of 18,600, 18,700. It has even gone down to 17,600. So any naive person who doesn't have the risk appetite will start panicking once he sees that such huge wild swings in the stock markets. So uh, although broader market says this is a bull run, but the moment the stock prices start correcting 5-10%, you start panicking and start selling, which is a very naive approach. Investors who put money systematically in the right shares and hold on to their investments patiently have seen generating outstanding returns. So it is prudent to have patience and follow a disciplined investment approach besides keeping a very long term, broad picture in mind. So the best methodology to be adopted for any beginners, uh, why just beginners, even for anybody who's into stock market, the best method would be a systematic investment plan. That is a timely investment of whatever be your money that you want to invest, whether it is 2000, 3000, 5000, depending upon what your saving capacity is. Carry out a periodic investment into the equity markets is what all major investment advisors would give you. And second, next is, do not let emotions cloud your judgments. Many investors lose money in stock market due to the inability to control emotions. It could be either fear or greed. These are the two basic emotions which everybody falls prey to at some stage of his investment journey. You either fear the stock markets when they'll start dropping share prices, or you start getting greedy and either you sell um, or hold on to a certain stock in spite of losing money. You should not, is again a very common phrase that one gets to hear in the stock markets is, never marry the idea of your stock. Never get hooked on to a certain stock just because you liked it or you spotted it, and irrespective of what the fundamentals of the stock are, you try to stick to it. So in bull market, the lure of quick wealth is quite difficult to resist. Greed augments when investors hear stories of unrealistic returns being made in a short period of time. Like you hear, when you know that these banks or any fixed deposits or any other instruments would give you around 8 to 10%, and somebody says this particular stock will give you 30%, 40%, 50%, you blindly, and especially this happens with penny stocks or even small caps, a stock which is just 2 rupees or 5 rupees or 10 rupees, you think that okay, it's just 10 rupees, let me buy 1,000 shares in the dream of that stock becoming 50 rupees or 100 rupees. So that is what greed can do to you. There are many examples, uh, like for example, Yes Bank had seen upwards of 100 rupees, and now it is somewhere languishing less than 20 rupees. So you should not go by what your emotions are. Instead of creating wealth, these investors just burn their fingers very badly the moment the sentiment in the stock market reverses. In a bear market, on the other hand, investors panic and sell their short shares at rock bottom price. Thus, both these words, fear and greed, are the worst emotions to feel when investing, and it is better not to be guided by them. Next is to create a broad portfolio. Like even Sir has mentioned it in one of our classes, that our portfolio should be very diversified, and in general also, like even other than stock markets, one should have your equal or some proportions of your investments in gold, real estate, fixed deposit, debentures, uh, and even within stock market, it should be diversified sectorally, like some portion in IT sector, some portion in pharma, some portion in auto, some portion in commodities. Whatever be your level, it could be as low as 5,000 rupees a month or 3,000 rupees a month. Try and diversify your portfolio so that your risk is spread in almost all the sectors. And next is to have realistic expectations. As I was mentioning earlier, when you know very well that the banks can give you only 8 to 10%, so one should not have unrealistic expectations of 30, 40, 50%. Yes, as past record would have been 20, 25, 30%, but it is not necessary that the same performance will be repeated year after year. One should have realistic expectations of 10, 15, 20%. I think that is good enough, and accordingly one should carry out the journey in the stock market. Invest only your surplus fund. This is a very, very key idea, that never should one carry out investment with borrowed money, borrowed capital, taking loans, or using your credit cards, and or using all your spare fund, sorry, all your savings and then put it. It is only a surplus fund which you think can be spared into stock market, and which you can afford to even lose about 5 to 10, 15%. Only that kind of funds is what is supposed to invest. Next is to monitor your portfolio on a regular basis. Although even this is even meant for long-term investors, it is good to have good pedigree stocks, like say Reliance or an Infosys, or an Apollo tires or an MRF tire or something. But at the same time, once you do an investment, one should periodically monitor your stocks and monitor your account, so that you see as to whether you're able to achieve your short term or mid term or long term goals. It doesn't mean that you look at your stock uh, every one day or every half an hour, every 1 hour. People are very obsessed at times to see where is stock price is moving for every rupee. That is okay for a trader, but for an investor, uh, monitoring his portfolio means watching it once in a fortnight or once in a month, just to see where his stocks are. Next, very important, slightly, I'm graduating to a slightly higher plane, and slightly using little technical words. Not that you're not aware about these words, but stop loss on every trade. Check the order screen on trading portal of your stockbroker, and you will see that there is a stop loss option. The word is self-explanatory. It means where to stop your loss. Like for example, you bought a stock for a certain amount. Let's say SBI for sorry. Let's say in SBI you bought it at 350 rupees. So you know that I'm expecting a higher jump from here. I'm expecting this stock to jump from 350 rupees to, let's say, 360 or 370 rupees in a month or 2 months. But for some practical, for some purpose, let's say the stock has come to 345, 345 rupees. And as a trader, let's say as a trader, you want to cut down on your losses, because generally traders carry out this kind of numbers when they're investing, let's say 2 lakhs or 3 lakhs. So even a 5 rupee drop in this share price would bring you down by 15,000, 20,000 rupees. So you don't want to lose more than 15,000 rupees, let's say on a investment of 1 lakh rupees. So you fix yourself that at a limit price of 345 rupees, I'm ready to sell the stock. So the moment you give this order to your stock broker, the price, the moment it touches 345, your losses are cut. Probably the price would have further gone to 340 or even 335 rupees. But you have set your limit that 345, that is 5 rupees loss is what the maximum that you can take, and hence your losses are cut. So for successful investment, it is essential to use stop loss on all of your trades. This is more pertinent to traders than investors, at least in initial days of trading. Next is avoid using the margin facility. This is a facility these stockbrokers generally give. When you're short of capital in investment, then this is one provision which the stockbroker gives you to help traders with this problem. Stockbrokers now offer the margin facility. For instance, a broker can provide you with a margin of 5 times on your capital. This means that if your trading capital is rupees 1 lakh, you can still buy shares worth rupees 5 lakhs. However, trades placed within margin are generally required to be squared off before the market closes on the same day. You can't carry forward. If you carry forward, then you obviously will have to give the entire money of the value of your stock. Margin facility may be beneficial for professional traders. Beginners are strictly advised to avoid using it, as it could result in severe losses. Only trade with capital you have and use the margin facility after gaining some experience of, let's say, a year, 2 year. Even when you start to do that also, start doing only for a smaller portion of amount and avoid bigger capital. Understand different types of orders. One will understand, one will learn in the journey of stock markets that there are many uh, types of orders. There's a normal order, there's a stop loss order that I was mentioning, there's a margin intraday square up order, there's a bracket order, there's a limit order, and the cover up order. These are nomenclatures one generally encounters, so one should identify himself before carrying out further in the journey. Understand how these different types of orders work to be a knowledgeable trader. If you're looking for how to invest in stocks for beginners with little money, it is better to stick to normal and stop loss orders. Normal orders can only be placed if you have the required capital for the purchase available in your trading account. Next, very important thing is do not short sell in the initial days. You can make money in the stock market even when the price is falling. Short selling is the opposite of placing a buying order. When the prices are falling, in the anticipation that a certain stock will fall to a certain price, you generally uh, buy at a certain price and then you sell it with the anticipation that you know for sure that this is going to price is going to fall. Even that means to say you can make money even when the price is falling. Short selling allows you to take advantage of a falling market. However, you should avoid using it when you're still new. Master the basic buy and sell order first before experimenting with sell and buy, which is in stock market parlance it's known as shorting. So avoid shorting in your initial days. Stay away from derivatives market. Another valuable stock market investing for beginners tip is to avoid trading stock derivatives. Derivatives market is mostly made up of futures and options. These are contract-based purchases with fixed expiry date. Just like the margin facility, the derivative market looks very attractive as it allows you to make bigger purchases with little capital. However, it is advisable to stay away, as I was mentioning earlier, just like the margin capital, even derivative market, the initial people traders should avoid. Stock markets is not for everyone. While stock market can be highly rewarding and a lot of people have made a fortune just from the market, it is not for everyone. It requires knowledge, skill, experience, and discipline. These can be only developed over a certain period of time. One of the most important stock market trading for beginners advice is to stay away from the market if you have tried it a few times, but things fail to work in your favor. If you're still interested in the stock market, you can consider investing in equity mutual funds. These funds invest your money in the stock markets and the portfolio is managed by experienced professionals. Certain other important do's and don'ts, I'll just run through them. These are given on the slide and self-explanatory. Start with a very small capital in initial days. Use a demo trading account to improve your trading accuracy. Always have a stop loss and target price before placing an order. Understand the technical and the fundamental analysis if you want to be a stock trader or investor. Diversify your investment if you have a long-term investment goals, and try to understand the financial reports of the company, that is the profit and loss statements, and what do the financial statements mean. One should understand the nomenclature. Certain don'ts are: do not trade stocks that are in news for good or for bad reasons. Stay away from external advice. Never invest the money you need. Do not get emotionally attached, and do not try to time the market. Finally, I've got this one slide. Well begun is half done is a popular proverb which perfectly suits beginners wanting to trade or invest in stock market. Yes, the world of stock market can be complicated and risky. However, if you're able to start right, you might actually be able to pave a path full of success and profit. If the motto is understanding the stock market, always remember that there is no quick or easy money in the stock market. One should not enter the market with such beliefs. It will require a lot of dedication, knowledge, discipline, and time. But if one has to, what it takes to succeed, the market can bring in great returns. If all this is just too much, one should prefer investing in equity mutual funds. They too invest your stocks and money in stocks, but the investment decisions are taken by experienced professionals to keep the risks to a minimum. These are certain miscellaneous market tips one can just go through. I'll not dwell on them. Most of them are repetition. One important thing which I would like to highlight is Do not buy based on rumors. You generally tend to listen that certain person is investing in so and so stock, certain venture capital is investing, or Rakesh Jujunwala is investing. So please buy this stock. This stock might skyrocket or give you uh, unimaginable returns. So one should avoid such rumors. Thank you. I hope I have covered the basics of the strategies that need to be uh, adopted by especially the early investors and the beginners. I'm ready to take on any questions. Should anybody have any questions to ask for?
Yeah, it was a very wonderful presentation by Mr. Swathi Kumar, which the presentation which deals the strategies of the stock market, and it was a it was his contribution purely based on, I would say, experience of his investment. That was very useful for us, I think so, and was given some advices which we need to should deviate from the derivative market. That's again, it's because the derivative market is much developed market in India as compared to other countries. So there are institutions still playing in derivative market, but the individuals, as Mr. Sodhi Kumar pointed out, individuals, as far as individual concerned, it's not uh, feasible. I also think like that. So, any questions on this? A lot of very interesting contents were presented here. Any questions on this? Please ask.
Sir,
Yeah.
is it suitable for newcomers to invest or to trade?
It's newcomers. Sodhi Kumar can answer.
Yeah, I mean, as I mentioned earlier, it is always good to start with investment. I mean, for all beginners who are in their early 20s, who want, firstly, it is always good to start as early as possible. And one should always start with small amounts, and investment is the only thing. Even if one wants to step into the realm of trading, the advisable is firstly to acquaint oneself fully with the nomenclatures and understand, and start dummy trading first for a couple of months. When I say dummy trading, it means paper trading. That is, you just carry out trading on paper and say, okay, if I do trading with, let's say, 10,000 rupees on a particular couple of stocks, what would be my result tomorrow? Will it be 12,000 or will it be 8,000? Then you do such kind of thing and then you calculate your profit and loss for a couple of months. Only when you're becoming perfect in your dummy trades for a couple of months is one should actually carry out trading. So as an initial person, it's always advisable to start with investment and subsequently only then jump into trading. I hope I've answered your question.
Yeah, I would also point need to explain. So investment is the early strategy rather than trading. So trading, you can start trading after. I won't promote trading. Actually, SEBI and these authorities, regulators are also not promoting trading. They are promoting the investment. So early people, the youngsters, they can start with investment. They can find some fundamentally good stock, as rightly pointed out by many experts in the stock market. Stock market investment is for the future generations. So for next generation you can invest. Some fundamental stocks, fundamental companies, they are giving dividend. So simply we just buy it and sleep, and these companies' prices, stock prices, will grow up in future, and you will get two times or one time in a year will get a dividend also. So that may be some value addition to you, and sometimes you may get bonus. So first of all, you have to identify some good companies to invest, and also find the entry point of investment. uh, Entry point in the sense, you cannot supposed to invest in an overvalued company. If the company is overvalued, so you cannot purchase that company's stocks. So just find out the price in which you can enter the market. That is very important. As right, Mr. Swathi Kumar, my point is correct or not?
Yes, sir, what you said is right. I mean, only one word that I want to add is very commonly used is systematic investment plan. The phrase itself is quite self-explanatory. You identify a certain stocks, and if you decide to invest 2,000 rupees or 3,000 rupees, or if you want to give a number to a shop, if you decided to buy two Reliance stocks or three Reliance stocks every month, irrespective of what the price is, just go investing on, let's say, 5th of every month, you want to invest, you want to buy three stocks of Reliance and two stocks of Infosys. Irrespective of what the price is, you continue to do that in the long run, let's say 12 or 14 or 24 months or 3 years. It will always be a good suggestion. And even if you buy certain mutual funds also in the systematic investment plan methodology, it will always yield a good result.
Yeah, that options are there, SIP and mutual funds. But still, people are, if you are more knowledge, you have more knowledge in the stock market and about the companies. You can directly invest rather than go for this SIP and all. This SIP and these mutual funds, some expense ratio. So based on the expense ratio, they may get some kind of income from you also, so in the form of expense. So
Yes, yes, yes.
yeah. So you should be careful about the expense ratio of these mutual funds and SIP. So I would suggest, if you are ready to get some knowledge or ready to study about the stock market and the stocks and companies, this is a very good option. But you should be careful about getting more knowledge, and the time of investment is also very important, and the entry point of purchasing shares is also very important. Right. Anyway, it was a very good presentation. Any more questions you can ask? Because right now the market is crashed somewhat because of the next variant of the COVID-19, and I would say that this is the best time to purchase some stocks, because some of the stocks reach their real valuation right now. And also, I would suggest the government is thinking towards the ban of crypto, or some kind of making some regulations of crypto. So I would say that the crypto is a very complicated investment. Recently, the Guram Rajan, the old RBI governor, has rightly pointed out that the problem of crypto is there is no underlying asset. So we have currency, means rupee, dollar, and all. So every time the government issuing this rupee, and they are keeping some assets, so in equivalent to the currency. And for the case of shares, shares are fully protected, and the shareholders are the owners of the company, and that way the underlying asset is there. And bonds, the bonds are also getting some underlying assets. But crypto, there is no underlying assets, just an invisible thing which is increasing and decreasing, only. But there is no underlying assets. That's the basic problem of crypto. And also, we can say that there's more than 6,000 cryptos in the world right now. So we don't need actually this much cryptos. And also, the cryptos are moving in accordance with the sentiments and emotions in the market. So all these cases, we can sum up that it is a very complicated investment, so that the government is trying to regulate and trying to ban. In China, it is already banned. So next week or sometimes the regulation will come up and discussed in the parliament, winter session of the parliament. Okay, so I would also wanted to say that the crypto market has emerged as a market which is very competitive to the stock market. Some people have already said that the stock market will end because the crypto market providing more returns rather than the stock market. So the people will invest in crypto market soon, and they quit stock market. But I don't think so. The stock market is the vision market in the world. The stock market will prevail continuously. right? Any opinion on this crypto by Swathi Kumar? So you can also contribute
So,
regarding. Yeah.
there is a lot of talk these days, but as many of the experts were saying that banning the cryptocurrency probably will not be feasible, nor is it practical. But some kind of regulation is what I think will have to be brought in. And as far as the end of stock markets or the cryptocurrencies taking over, I think it is just one of the many avenues to make money, like the way we have various commodities and various metals like gold and all. Similarly, cryptocurrency also will continue to be as part of one this thing. Yes, you will definitely see the way it is rising. It will definitely see a crash also in one of these coming months and years. But overall, I think India will need to adopt to these new technologies.
Yeah, it's a technology wise, it's okay, but we don't need actually these 6,000 cryptos. We cannot understand some of the cryptos, and there are first generation cryptos, second generation cryptos, and third generation cryptos. In first generation crypto, the first crypto, that is Bitcoin, is there, and second generation, the one of the top means it's very talented crypto is there, Ethereum, and the third generation there is Solano. And I would say we had conducted a study recently, and there is a price maker and price follower is there. So the Bitcoin is the price follower of this Ethereum. Whenever there is a price increase in Ethereum, and the Bitcoin price also increases, and whenever a price decrease in Ethereum, Bitcoin prices also decreases. So there is a market mechanism is working on it, and regarding the setting of prices by one crypto and the other crypto which follows. So that kind of the different market mechanisms are working in this crypto. Okay, and also am I audible? Am I audible?
Yes, sir. Yes, sir. You're audible.
Okay. So that's the case of crypto. So the stock market, anyway, the crypto market is not a competition to the stock market. Okay, any more questions? So it is I would say that it is a very good business if you can start the investment business. So, but the thing is, as rightly pointed out by the Mr. Swathi Kumar, about this knowledge, skill, and strategies of investment. So, if you are a winner, if you are a knowledgeable person, you definitely win the market. So, any more questions? If no questions, we can go to the next presentation. One more presentation we can do right now.
Thank you, sir.
Okay.
Sir, may I present?
Yeah.